How's it going, everybody? I'm Scott Trench. I'm CEO of BiggerPockets, and I'm here today to talk about the December stimulus package and the impact it might have on the single-family rental real estate market. While 2020 has been a really weird year, I know it's been a remarkably and perhaps surprisingly good one for the owners of single-family homes, and especially single-family rentals in this country. We've seen a lot of appreciation in prices, and we've seen some solid rent growth. Not in every market, but in many of them. I don't know if you guys remember this, but back in early April, a bunch of big-time news outlets were talking about how nearly a third of American renters didn't pay April rent. Well, those headlines got a lot of clicks and some good discussions going on BiggerPockets, for example. But the fact of the matter is that the biggest reason for the drop in April rent collections was due to the dates. And what I mean by that is April 1st, we measure rent collections up through the 5th of the month. And April 1st through 5th last year was a bunch of weekdays. April 1st through 5th in 2020, April 4th and 5th were Saturday and Sunday in 2020. Banks are closed on Sunday, and that was the reason for lower rent payments. False alarm, the real estate market didn't crash, and doomsday did not materialize. All in all, rent collections have been remarkably strong for landlords in 2020, in spite of what some of those headlines might have led you to believe. We're estimating that landlords will collect between just 2 and 3% less rent in 2020 than they did in 2019. In fact, prices have increased for rents across the country, at least for single-family rental homes. That, coupled with strong appreciation rates, and again, many landlords I know are having one of the best years in a long time. That said, it hasn't been a picnic for the entire industry. Apartment rents have actually fallen year over year. Renters and homeowners alike seem to be ditching the apartment complex for single-family homes. And of course, again, this dynamic is impacting some markets differently. It's not a good year to be an investor in San Francisco or a landlord in New York, but it's perhaps not too bad a year for most other folks in most other cities. And again, specifically referring to those single-family rental homes. Though maybe a different story even for duplexes, triplexes, quadplexes, and especially those large apartment complexes. And I think the reason why we can all agree, or maybe most of us will agree, that we're not having that doomsday scenario or a lot of these lack of collections of rents or drops in rents and big drops in prices is because of massive, unprecedented government intervention at the largest possible scale. So let's talk about that, the government's role in the single-family market so far this year. While the $1,200 stimulus checks might have made all those headlines, I think the real backbone of the rental market in 2020 has been the CARES Act's impact on unemployment and its expansion of benefits specifically. Unemployment benefits in the United States are complicated, but to understand how they might impact the rental market, let's look at two things. First, the amount of unemployment benefits that the CARES Act provided, and second, the way that they impacted the length or duration of those benefits. So first, let's talk about the amount of employment benefits. Prior to the CARES Act, unemployment benefits averaged about $378 per week. The CARES Act slightly changed some of the minimum and therefore average payouts to about 50% of the recipients' previous weekly payouts. But it also added $600 per week through the end of July. That's a massive 200%, I guess it's not 200%, but 175%, 150% increase to stimulus payouts or unemployment benefits. That had a huge impact, I think, on the rental market and really allowed a lot of people to pad their savings a little bit, and muted that impact that this massive unemployment might have had on rents. And the second thing is the duration. Most unemployment benefits expire about 26 weeks. It varies by state. There's a whole bunch of nuance to this. That average number that I threw out earlier, 378 per week, that can vary a ton. But most unemployment benefits were expiring about 26 weeks after getting started prior to the CARES Act. For example, if you got laid off on April 1st, your benefits might stop around September 1st. Under the CARES Act, benefits extended for 13 more weeks. So in that case, somebody who got laid off on April 1st might stop receiving benefits on December 1st or much later. That person that we're talking about is receiving not only more unemployment benefits for a big chunk of the year, but they're also receiving them for a longer duration. As a student personally of the small residential real estate market, 1 to 4 units in particular, the two periods this year that worried me a bit were September and then January, this upcoming January in 2021. September worried me because I had wondered just how important that $600 bonus per week was for many households. that $600 bonus unemployment, that ended at the end of July. So I figured it would be available for August rent, but maybe not for a lot of folks for September rent. Well, that concern again appears to be unfounded, as we didn't see a collapse or really any noticeable changes in the rental market come August. January 2021 was also beginning to worry me a little bit as well, because with all the turmoil going on in politics this year, I wondered if the government would pass yet another round of stimulus package, at least at this point in the year. Well, I'm sure you can tell from the headline or the title of this video, yes, we passed another round of stimulus, and I think that January 2021 is not going to be a doomsday scenario for investors or even maybe a major blip. While there were a lot of other factors that I glossed over in the CARES Act, like the PPP programs, that would preserve jobs, the $1,200 stimulus checks that made all the headlines, for me, the real meat and potatoes of that act was the benefits and the expansion of benefits for unemployment, that good old-fashioned unemployment insurance, although I guess a seriously turbocharged version of that. All right, let's get to the meat of this, though. Current December stimulus. What does it mean for real estate investors? I know that was a lot of background, but I think it was important to review that and have it all as context as we digest the latest on this massive stimulus package that just came out. So let's recap it first of all. We've got about a $900 billion stimulus that just passed. And in that stimulus, we've got $325 billion for small business, $82 billion for schools, $69 billion for public health measures, $45 billion for transportation, and then we've got $286 billion in direct aid. That's another round of direct checks, $600 for most American families, plus a continuing expansion of those unemployment benefits, which again, to me, are really a big part of the story here that's propping up the single-family rental market. We've also got another $25 billion for rental relief, which I'll talk about in a second. While the new stimulus goes a little lighter on the stimulus checks, again, $600 per person instead of $1,200 that we had in round one, it continues to pump money into unemployment. That $286 billion number is inclusive of those stimulus checks plus the $600 checks plus the expansion of unemployment benefits that are continued for another 11 weeks, moving through March 14th, 2021. And on top of that, those unemployment benefits are going to be boosted by another $300 per week. Again, that's almost 100% increase over the average unemployment check that we were getting prior to coronavirus. Again, this is the heart of the bill, in my opinion, as it relates to real estate investors. Yes, the small business stimulus and some of the other stuff will indirectly impact the rental market, but this is a direct impact for those of us who invest in single-family homes. Again, the other piece of the bill that impacts real estate investors is it's less than 10% of that $286 billion number, but it's still a large number, is the $25 billion allocated for rental assistance. That's going to be allocated towards lower income families and help them pay off past due balances. Alongside that, the measure also extends the eviction moratorium through January 31st. Some economists are estimating that tenants nationwide might owe about $70 billion in back rent by the new year, or about $5,800 per family for 12 million families. I think that eviction moratoriums are going to be have to paired with more of that rental assistance, that $25 billion number. I think that by the time this is all said and done, we could be approaching that $100 billion number. And I think this is America, and our government is going to have a hard time halting evictions without making property owners whole on rents. I think that if they don't do that, there's going to be a lot of lawsuits and challenges associated with that, with landlords suing tenants for back rent or suing the government for some of that back rent. So while it might seem frustrating to some landlords not to be able to evict a tenant in the current period if they're not paying, I wonder if the eviction moratorium is perhaps sadly going to be ultimately a form of subsidized rent for a lot of landlords. All right, so what do I think is going to happen based on all this? Well, I'm going to go give you a pretty boring prediction. I think 2021 is going to be a little bit more like 2020. I think that we're going to continue to see significant property price appreciation, and I think we're going to see modest rent growth in the single family housing space in particular. It doesn't necessarily extend to apartments and those other things. The reasons I believe that are because I think the big levers in our industry, the biggest things that could impact real estate investors, are going to be interest rates, tenant demand, inflation, and supply. So let's walk through those one by one. Current government policy is to reduce interest rates and assure everyone that low rates are here to stay. Low rates mean lower payments and rising property values. Most people, when they're buying a home, care more about the payment than they do the price, especially in the single-family housing space, which is what single-family rental owners are in, right? And so when that payment reduces, that if interest rates fall, that allows homeowners and to have more purchasing power, buy at a higher price point with the same payments, and it allows the landlords to cash flow on properties that are more expensive because the payment's lower. They can buy a property at a higher price point and still produce more cash flow. So lower interest rates mean lower payments and rising property values. Current government policy also is to double and triple down on economic stimulus generally and to distribute straight up cash to unemployed and lower income folks generally, also to provide rental assistance. I think that's going to keep demand strong for these properties, and I think we're not going to see, unless that policy stops, I don't think we're going to see a constriction in demand in the sense that tenants are going to move in with one another like we saw maybe in 2008, and it was a little bit more difficult to find tenants in general. So that's on the demand side. Inflation. We're taking out a lot of debt and spending a lot of money, and I don't know if we're going to be able to raise taxes in the near future to cover those expenses. To me, that smells like inflation, and I think deflation is a huge problem for our federal government. If I'm right, we're going to see inflation. Inflation is the real estate investor's friend. We are borrowing often on long-term notes or owning the properties outright in cash. And when inflation occurs, the most scarce and dear assets appreciate or rise in price first and fastest. And I think that that's a friend to the real estate investor. And then lastly, we have supply. I don't see a big change in supply coming. We're not going to build a bajillion new homes. I don't think we're building enough as things currently stand. And I think we're going to continue to see rents and property prices increase until we do, even if that inflation or interest rate changes that we just talked about don't occur. I think that Congress is going to keep pumping money into the economy until this pandemic is over, whatever that means. I think that the Fed is going to keep interest rates low for some time. And I don't think any sane tax hike can possibly pay for the actions that our nation has taken this year in 2020. And again, if interest rates are here to stay, that tells me prices have even more room to climb. It may seem insane. I think with the lower interest rates that we're seeing today, is if they stay low, I think that people are going to continue to be able to buy. So to conclude, it appears to me that the current set of policies are likely to create a world in which low interest rates might be here to stay, in which rents are being subsidized by society through taxation, government stimulus, and ultimately inflation. Now, I know I'm sitting here as the CEO of BiggerPockets saying that I like real estate and think that it's going to benefit from the current state. I get it. It's a conflict of interest. Know your source and all that. But honestly, I think that's the case. At least in the short to medium term, I think that we're going to see benefits to the real estate investing community. And one day, when interest rates rise or Fed policy changes and inflation is it maybe perhaps under control, or we have a policy that's more likely to control it long term, perhaps we might have a giant mess to wake up to as single-family real estate investors. But I wonder if that day might be some time off. Again, I'm just one guy, and I could be completely wrong on all of this, but that is how the market is presenting itself to me today. I also can't resist, and I got to leave you with one parting thought here. Take a minute and consider the big levers that our government is pulling to stimulate the economy. One, effectively insuring landlord rents with unemployment and rental relief benefits. Two, forcing interest rates lower, with the Federal Reserve forcing interest rates lower. And three, doing so in a way that I think sets the country up to take on a large amount of debt, and I really, in a way that I don't think is feasible to repay just through tax hikes alone in the next couple of years. I think that sets us up for inflation. These items, in my opinion, combine to destruction of wealth for the poor and middle class, siphoning that wealth from wage-earning Americans and into the pockets of landlords and real estate investors. Maybe the alternative is allowing evictions to take place, rents to correct, and renters and landlords alike to go bankrupt. That's a hard, stark reality, and I get it. I get why we're not necessarily facing that reality or doing that as a government. But I wonder if the consequence is that accretion of value to the landlord at the expense of a lot of the rest of society here. Well, I'll leave you with that. What do you think? Am I right? Am I crazy? Let me know in the comments here, and I'll check them out as they come in.